So, what if the very foundation of the global economy is about to crack? Today, we're going to dig into a financial tremor that's starting in a really unexpected place, and it could soon shake everything. Think about it like this. For the last 3 decades, the entire world has been propped up by this very strange economic situation in Japan. But now, that foundation is showing some really deep fractures. And for the rest of us living on the floors above, well, we're starting to hear some very unsettling noises. What we're really talking about here is a financial earthquake. And its epicenter isn't where you'd probably expect. See, this isn't a story about Wall Street or London. The tremors are starting in Tokyo, the quiet giant that's been holding everything up for so long. And the scale here is, well, it's almost impossible to wrap your head around. We're talking about an explosion in the Japanese government bond market, a market worth over $7 trillion. That's a number big enough to completely reshape the entire global financial system we all depend on. Now, to really get how we got here, you have to understand Japan's totally unique role over the last few decades. It basically became the world's free ATM, just dispensing trillions in super cheap cash that fueled global growth. Let's break down how that actually happened. So, it all started back in the early 90s when Japan's massive economic bubble just burst. To fight off a total collapse, the Bank of Japan did something pretty radical. In 1999, it cut interest rates all the way to zero. For almost 3 decades, while rates everywhere else were going up and down, Japan kept the cost of money at practically nothing. And this created a massive global opportunity, a financial strategy so popular it got its own name, the yen carry trade. The idea behind it was incredibly simple, yet unbelievably powerful. Okay, so here's how this crazy money machine worked. Step 1. A big investment fund borrows, say, 1 billion yen in Japan, and they pay next to nothing in interest. Step 2. They instantly swap that yen for US dollars and buy super safe US government bonds that are paying, let's say, 4%. Step 3. They just sit back and collect that 4% difference as almost pure profit. It was basically a license to print money. And how much money are we talking about here? Well, the estimates are just staggering. At its peak, the yen carry trade was a $20 trillion global phenomenon. To put that in perspective, that's bigger than the economies of Germany, India, the UK, France, and Italy combined. This was the cheap fuel the world got completely and totally addicted to. So this brings us to a hypothetical but, and this is the important part, a very plausible future. Let's imagine it's early 2026. A single political decision in Tokyo is about to throw a massive wrench into this 30-year-old machine, and it's going to trigger a full-blown market rebellion. Here's how it could all go down. A new prime minister, Sanae Takaichi, announces a massive $135 billion spending package to try and jumpstart the economy. The problem? She doesn't really say how she'll pay for it. Then she calls a snap election to get a mandate for even more spending. And the very next day, at a routine government bond auction, investors just revolt. Nobody wants to buy Japan's debt anymore. And you can totally see why, right? Global investors looked at Japan, a country whose debt is already over 260% of its entire economy, the highest in the developed world, and they see a government planning to borrow billions more with no clear plan. So they all collectively asked one simple, terrifying question. How are you going to pay for this? And when the answer didn't come, they panicked. And the collapse happened with breathtaking speed. I mean, for years, Japan's 10-year bond yield was locked near zero. And then suddenly, it skyrockets to over 2.3%. The 40-year bond yield blows past 4%. These are moves that should take years, not hours. In a flash, billions of dollars in wealth just evaporated. And this, right here, is where the local tremor becomes a global tsunami. The crisis didn't stay contained in Tokyo. Not even close. Within hours, the shockwave began to ripple across every single major financial market on the planet. Because remember, who owns a ton of America's debt? Yep, Japan. Japanese investors are the largest foreign holders of US Treasury bonds. So, as the crisis hit home, they started dumping their US bonds to bring cash back to Japan. This flood of selling caused US bond prices to fall and their yields to spike, sending the cost of borrowing for the US government and for everybody else soaring. This was a complete
180-degree reversal of a 30-year trend. The old game of borrowing for free in Japan to invest in the US was officially over. I mean, after all, why would a Japanese pension fund risk investing in America when they could suddenly get a safe 4% return right at home in their own currency? The world's ATM had just been shut down for good.
So, why does a failed bond auction on the other side of the world even matter to you? Well, because the invisible architecture of global finance connects directly to your wallet, your savings, and even your job. When U.S. bond yields rise, the cost of pretty much every loan in the economy rises right along with it. That means higher rates for your mortgage, your car loan, your credit cards. It means companies pay more to borrow, and they pass that cost on to you through higher prices. And it means turmoil in the stock market can take a real bite out of your retirement account. The hidden engine of the world economy just got a lot more expensive to run. Which brings us to the biggest question of all. Are we witnessing the end of an entire economic era? I mean, for 3 decades, the world has been addicted to a constant supply of cheap money flowing out of Japan. And now we might be facing the incredibly painful process of withdrawal. What this all means is that the 30-year party of unnaturally low interest rates could finally be over. We are likely entering a fundamentally new period, one where capital is no longer cheap and money is definitely no longer free. And that leaves us with a critical thought. The world has built its entire modern economy on the assumption that there would always be an ATM in Tokyo ready to spit out nearly free cash. So what happens when that machine is permanently offline? What does the withdrawal from that 30-year addiction actually look like for all of us?